Hello everybody. Welcome to my series of webinars about risk and money management strategies and techniques for beginners to use in their trading. This short webinar is about a risk management strategy called the 2% rule. Let's imagine that a successful trader sits on a chair that has three legs: fundamental and technical analysis skills, psychology and discipline, and risk management. The inability or lack of knowledge on how to manage trading losses is a very dangerous quality to have in trading. Risk management is an absolutely vital component to any trading strategy and to your overall success as a trader. Following its rules will allow you to make calculated risks instead of gambles and protect your portfolio health from huge losses over time. So why do 90% of traders lose their deposits then? There are many reasons why this happens, but probably the most common two reasons are: A. They put on trades that are way too large. Often, after a series of wins, some traders start feeling invincible and take unnecessary risks by placing trades much bigger than they should have. When these trades go bad, they can erase many previous weeks and months of steady work. Huge and sometimes irreparable damage is done to the portfolio this way. And the second reason is that they don't use stop losses. Trading without stop losses is like driving blind. It makes losses unlimited. Risk management works only if you use stop losses. Always use them. The 2% rule is a very important rule in risk and money management. Let's take a look at why and when you should use the 2% rule. This rule is designed to protect your account from big losses caused by one single trade. Let's take a look at a scenario. Let's say you start off with $10,000 and on your first day you make a trade worth $3,300 and it gets wiped out for whatever reason. Stuff happens. So in order to come back to even, you're going to need to generate 33% profit with your remaining capital, which is already 1/3 less than what you started with. So that's why always and always you should use the 2% rule. This rule is also known as the 1% rule. But don't be confused. What numbers 1% and 2% here mean is the risk tolerance of any given trader. Conservative traders, they usually prioritize preservation of capital over quick market returns, and they will likely choose a smaller number, like 1%. Aggressive traders are the other way around and prioritize quick market returns over preservation of capital over time, so they will likely choose 2% as their risk tolerance. You don't have to choose either or. You can be a trader in between, like you can choose 1.5% if that's what you're comfortable with. What we need to understand here is that we need to pick a number that corresponds to your risk level tolerance, and we need to stick with that number. Let's say that you are on the aggressive side and you chose 2%. What this means is that you are now prohibited to risk more than 2% of your account equity on one single trade. Now, this is not the size of your trades, it's the size of your risk that you're allowed to take, and I'll explain it a little bit further. You can always risk less than 2%, but never more than 2%, or it will defeat the whole purpose of the strategy. Let's take a look on how to use this rule and to calculate our trade position. We're going to use stocks in this example. First thing we need to do is to calculate our risk. Let's say that you have a $50,000 account. If you stick to the 2% rule, your risk per trade is $1,000. It's the dollar amount that you're allowed to put at risk on any single trade, never more. Always plan your trades ahead by knowing when to enter a trade, when to exit it, and where your stop loss is. For example, you're buying a stock at $100 per share and your stop loss is at $95 per share. You are risking $5 per share. Now we will divide your total amount of risk of $1,000 by your $5 risk per share, and you will get the number of shares you are allowed to trade. You can trade less than 200 shares as we calculated, but never more than 200 shares. Stick to your plan. Never move the stop loss away from your profits hoping the trade will turn. Only move the stop loss away in the direction of your profits. Only and when it makes sense. Otherwise, you will upset all your risk per trade and the whole strategy will fail. At this point, you will be gambling and not trading. And now, let's go over a similar example, but this time we're going to use Forex and pips. First things first, let's calculate our risk. Let's say that you have a $5,000 account. If you stick to the 2% rule, your risk per trade here is $100 including fees. It's the dollar amount of risk that you are allowed to have on any single trade, never more. This value is not constant for all currencies and can change. You have to look it up on your broker. Let's say that the price per unit of your currency is 10 cents. For even number, I like to align the amount of units I trade so that I trade around $1 per pip, and I'll show you a video how to do it later. So now let's decide how many pips can we risk. If your trade size in units makes you trade $1 per pip, it means that you can only risk 100 pips and not a pip more on this trade. Your stop loss should be at 100 lost pips or less, never more than that. Stick to your plan. Never move the stop loss away from your profits hoping the trade will turn. Sometimes it will, but most likely it will not. Only move the stop loss up in the direction of your profits, only and when it makes sense. Otherwise, you will upset your risk per trade and the whole strategy will be useless. At this point, you will be gambling and not trading. Here's an example of a calculator I was able to find on myfxbook.com. So first things first, we select our current currency, and then we need to find the currency we're about to trade. Let's say it's going to be Australian dollars to American dollars. Now, what we need to do is to put, for now, let's even put a random value of 5,899 units and click calculate. So we go back to our table and you see that this amount of units will cost me around 59.60 cents per trade, per pip worth of movements. So if I need to match up my unit size, my trade size to $1 per pip movement, I'm gonna need to add more units here. Let's say it's 9. Calculate. Almost there, but not quite. 10. Perfect. So here we are. This means that if my trade size will be 10,000 units, then for each pip worth of movement, I will either win or lose $1. I hope you found this information useful and it will help you to avoid big losses down the road. I wish you good luck in trading, keep calm and continue trading.